So I finally learned to wait for that flash of your face, Rick, before talking. Welcome back, everyone. We have another special guest here that we'd like to invite to the stage, and that is Dr. Nomi Prinz, who headlined our event in Boca Raton. So please, Nomi, please join us on the stage, and we'd like to continue the discussions that we had with you in Florida recently.
I think I'm here.
You are.
Excellent.
You are. Delighted to have you back. I, of course, prefer to have our in-depth discussions like this at the bar in Boca Raton, but we'll have to make do with what we have. For benefit of the virtual attendees who weren't in Boca Raton, if you could give us just 60 or 70 seconds about your background, what it is that you did before you became a pundit, and what gave you the experience to become a pundit.
Wow. Well, going back to Wall Street a couple decades ago, I was a managing director of Goldman Sachs. I was a senior managing director at Bear Stearns. I ran groups, 30 to 40 members each, that basically focused on commodities, derivatives, portfolio strategies, central banks, traveled the world, saw and met with every single almost central bank on the planet over the decades there and since. And left after 9/11, basically to talk about it all, to continue to keep my eye on the ground and share with investors and people out there things I've seen, things I'm seeing, and things I'm going to see.
So, Nomi, it's important that the people who are listening to this discussion don't think of it as a substitute for the discussions that you had in Boca. It's important that people take this discussion in the context of your general session speech, which I think was very, very important. The turmoil on Wall Street that we saw before the conference, if anything, has been eclipsed by the turmoil since. Perhaps you could describe in brief fashion what you see in terms of disintermediation on Wall Street, in terms of the destruction that's being done to Wall Street's balance sheet, and the things that you see happening in securities markets that our investors need to know about and concern themselves with.
Sure, thanks. And again, being on stage in front of everyone in Boca was incredible, as were the conversations at the bars there. So I just want to say that. In terms of what's happened since then, and what I see happening going forward, is we talked about what the Federal Reserve has done to money since the financial crisis, and on steroids since the pandemic, which is it's just kind of created it fast and loose. It has an almost $9 trillion book of assets. Central banks around the world have a $41 trillion book of assets. What does that mean? Money's been injected into the banking system and the financial markets through artificial means, and that money was created, not produced, not made. And that's created distortions between the real economy and the markets. It's also now created a lot of volatility in the markets because the Fed has started to raise rates. Now, that said, rates are up to about 2.25 basis points. That is where they were in the beginning of 2019 when the Fed pivoted. Different situation because we have inflation now, but it's really important for everybody listening to know that the reason they pivoted is, to your question, Rick, Wall Street banks started exhibiting signs of trouble in the middle and towards the end of 2019. Now, that was not public information. It was only gleaned if you looked at their balance sheets, which actually were public in their quarterly earnings statements, but not necessarily in between. What was going on was, as money had tightened, Wall Street banks were having problems with their customers, with their biggest corporate customers to whom they were lending money. This is starting to happen again, as rates have been raised for a number of reasons. And in the backdrop, Wall Street is beginning to struggle. Its deposits are lower. Its assets have not grown by as much as they have in the past. And it's seeing its loans starting to buckle and its credit lines starting to buckle. The Fed will see this and not talk about it, but it's something to recognize is happening in the background that could spur a Fed pivot to neutrality or even to lowering the pace of their rate hikes in as soon as the next FOMC meeting period. We had a 75 basis point rate hike last time, 75 basis points before that. I don't believe we're going to have another 75 basis points. I think it's going to be 50 because they're looking at these factors. It doesn't mean they've fought and won against inflation. A lot of inflation, particularly in commodities, has not been about what the Fed has done. But in the financial markets, it has been. And the Fed's going to have to consider and balance that in quiet, even though they're not necessarily doing that in public. That's going to create opportunity in the commodities markets. And that's also going to create opportunity in all of this chaos for certain stocks that have real future productive values attached to them, and that people should either invest in or hold if they've been down through this tumultuous period.
Now, Nomi, you existed in the belly of the beast at Bear Stearns. You saw what happens when one of these things comes apart. You said something interesting in the beginning of that excellent answer that you just gave me, which said that the truth was evident in the balance sheets and the income statements of these financial supermarkets going back to 2019. I may be the world's only accountant wannabe. I like to peruse the balance sheets and the income statements in a lot of industries, including financial services. And I need to say that some of them, JP Morgan Chase, Citicorp, Goldman Sachs, are incomprehensible to me. I don't know if it's by design or if I'm dumber than I think I am. But as an example, when I look at the JP Morgan Chase balance sheet and I see the nominal value of derivatives in the $100 trillion range, and then I look at the reported exposure relative to offsetting liabilities, I guess where the question goes is, inside the beast, do they understand their balance sheets? And is Wall Street adequately capitalized, actually?
So I'm going to go with no on the second one. Wall Street isn't adequately capitalized, and that's one of the reasons the Fed can't really do QT substantially. That's one of the reasons they're starting to buckle in terms of the reserves that they need to put for themselves internally, not to mention that they have to present with respect to these things called stress tests, which the Fed gives them periodically and which are designed by them. So with JP Morgan Chase, for example, they quote failed some of the money that they had aside for emergency cases, or the reserves that they had on their balance sheets, on a stress test that they effectively designed, which is never a good sign. Citigroup the same. So basically it's like, you're doing your SATs, you've created the SAT test, you've done all these like really simple words, like what's another word for blue? Is it light blue, dark blue, or pink? And they get it wrong. Right. So that's starting to happen now. And now when you talk about notional derivative size, and this is one of these really weird things where a lot of people who work within Wall Street banks do not understand, but go with. And that's the fact that what a notional derivative is, it's the value that particular derivative represents. It's not the cost of that derivative. It's not the risk that derivative represents. So it's a very big number, and therefore they can never reach, in risk management terms, the notional value of derivatives that they have on their books. What does that mean? That means they're over leveraged. It means if everything goes okay and their derivative positions are fine, and they quote hedge them or sort of manage their risk in some way, that everything's not going to come crashing down or crumbling for the banking system. But what has happened recently is banks have over leveraged their derivatives positions because they have had an abundance, an additional injection of cheap money, notwithstanding the last few months, and of extra money in the system, which still exists. It's still there to float. That $9 trillion or so dollars is still there to float. So they were able to bulk up on derivatives positions and on the notional or full value of those derivatives positions without having to really manage around them, because nobody's really looking. This is the kind of problem that occurred in the financial crisis of 2008, in that banks had bulked up on their asset and derivatives positions in terms of assets related to subprime loans and credit derivatives, or derivatives related to the solvency of the developers and everyone else in the real estate market, financiers and so forth that were involved in those loans. That's kind of what's happening or starting to happen now with respect to other forms of corporations, and also with some mortgage loans. We're starting to see more foreclosures happen around the edges and all sorts of other things. So in general, they are not as well capitalized, despite what the Federal Reserve might say, and despite $9 trillion worth of cushion, as they had been even 2 years ago.
Although I could talk to you about derivatives for the rest of time, probably we should move on to other places. In terms of your discussion of cheap money, part of me says that any time that you have a negative real interest rate, which is to say, any time that interest rates on, say, the U.S. 10-year Treasury are substantially below the underlying rate of inflation, that money's cheap. I realize money is sometimes absolutely cheaper than other times. But do you think, first of all, that the political or institutional will exists in the United States to return to a period of real interest rates, which is to say, where savers get a fair shake at the expense of spenders? And do you have a sense of what level of negative real interest rates the economy could accommodate over time?
I don't think we're going to, quote, get back to that level. I think what had happened in the wake of the financial crisis and the pandemic is that we've so far passed, the peer of that point where interest rates actually make sense relative to inflation and relative to helping savers. I don't see us getting, quote, back to that point, because in order to do that, not only would rates have to be raised substantially and at least to meet inflation on a real basis, but the Fed and other central banks would have to unwind nearly $40 trillion worth of assets. And that's just not going to happen. The reason that's not going to happen is because they don't really care about savers, and they don't really care about the real economy at that monetary sort of financial and banking level. They don't want that big a crash. Now, what we've seen this year is markets come back a lot, certain commodities come back a lot, growth slowing down, a technical recession evolving in the last two periods of GDP, and other problems around the world. And yet, the Fed still can't unwind its balance sheet, nor can other central banks, to any sort of speed or amount by which you would get to a real interest rate environment. We talk about Volcker in the 70s and 80s, and well, what happened in the 70s in terms of commodity spikes, what happened in the 80s and so forth, when rates went up to 20% in the front end. And the reality is that period had a very big difference that this period doesn't have, net of high inflation. And it was higher then. That period did not have this cushion. It did not have a 3-to-1 debt to economic size factor across the globe. Yes, there was high debt, but it is nothing like what there is today. Today was sort of inverted the whole relationship of what money actually does to such an extent that you would have to unwind all of that to get back to some kind of a normal. So I just don't see that happening. That's why in my new book, which I call Permanent Distortion, I literally mean that. It's not, we're not going back to anything. We are in a permanently distorted world where what money and markets do and represent are very detached from the activities of the real economy and people that pay bills every day and live in it and do try to save at some modicum of real value. And that's why the stock market and commodities continue or will continue after these sort of interim volatility periods to rise, because we are in a period of cheap money.
One wonders, of course, how this ends. So let's explore that. In your experience on Wall Street, is the focus of the Wall Street player so much on quarterly cash bonuses that they're unconcerned about the probability of continuing with permanent distortion?
Nobody on Wall Street who trades a book, who gets an annual bonus, who has a conversation with their manager every quarter about how their book is doing, cares at all about what's going on in the real world. Now, they might care in their own personal lives what's going on in the real world, but in terms of what makes Wall Street tick, none of that has changed. What makes it tick is that next quarter, it's the next bonus, it's the next trade. And those trades, and one of the things we're seeing now, which is why banks are looking weaker and they will into this next quarter, is that they're trading volume with outside of Wall Street people, with their actual customers, has declined because of volatility, and people are less confident about where they're putting their money at this precise moment. But from an internal trading perspective, from a deal perspective, from an investment banking perspective, and an M&A perspective, everything that Wall Street makes money out of in chunks, they could not care less what's going on in the real economy. They can always trade against it. They can trade around it. They can find sectors that don't have money in them yet, where they can basically push cheap money into when the conditions warrant. When I was working on Wall Street and in London and basically around the world in finance, there was literally no conversation. I mean, zero conversation about what we were doing with respect to the real economy, and that included getting involved in massive corporate deals with emerging market countries. They're getting slammed by so much debt at the time, and today we have a situation where that debt is even more cumbersome for some of these countries, and cheap money has only allowed them to sort of continue to push it forward. But no one cared. Like literally nobody cared, except how is this going to impact the trade I have on, the quarter coming up, and more importantly, my bonus at the end of the year.
So let's move from beating up on Wall Street to beating up on our attendees, just for fun. When I look at various things out there that scare me, one of the things that really scares me is the emergence of ETFs in below investment grade credit products. The idea that you could structure a $500 or $600 billion ETF around illiquid securities. I remember growing up in the over-the-counter bond market, a treacherous place indeed, and we had a saying called an owl bond. And an owl bond is one where you went to sell it and you called your broker, and your broker went, "To who? To who?" And I'm very concerned about a circumstance where there was a bit of a credit scare, where people went to sell the ETFs and the ETFs went to sell the underlying securities, and the underlying securities would go no bid. Is that something that scares you?
Oh, absolutely, because now our world runs on ETFs. In the beginning of the ETF, everyone has an ETF or multiple ETFs. There are multiple ETFs, more importantly and scarily, on similar assets and on similar junk bonds and on similar questionable stocks. And so you have this knock-on effect where it's not even just one ETF; it's multiple sets of ETFs potentially pointing to the same crappy bonds or stocks. And that is definitely a problem, because when the unwind comes for two different reasons in ETFs, right? They come because investors in those ETFs need the money, are scared, cash out, whatever. And that has a knock-on effect of shrinking the value of the investments that the ETF is in or that it's representing. And that has a knock-on effect on reducing the size, and that has a knock-on effect on reducing the prices in the market. So you have this whole sort of psychological and then to fruition cycle where things can crumble very, very quickly. When you have an asset manager like BlackRock controlling $9 trillion worth of assets and multiple ETFs across multiple bonds and stocks and assets, you have a problem when they unwind, and they can unwind for different reasons. They can have a margin call in like the trading part of their book. Again, their customers can leave. Customers can leave in droves, and that creates a cascading down effect. We didn't have that in the beginning of ETFs. We've grown into that risk as the ETF market has increased, and that's one of the reasons that when I look at investing. And sure, ETFs serve a purpose in terms of aggregating a concept or set of stocks or whatever. But I look at specifics. I look at individual holdings rather than on investing in ETFs per se, because of that very reason.
Yeah, I myself use ETFs to give me access to beta in market sectors that I don't understand. But I certainly want liquidity. And the idea that there's this preponderance of ETF capital in illiquid securities bothers me. I will talk to retail investors who are so focused on yield that they don't seem to focus on either credit quality or stock to float difficulties with regards to coming off positions. In a sector that I come out of, the volatile natural resource sector, one of the things that you see even with actively managed portfolios is when they're experiencing disintermediation, the manager often has to sell his or her best positions because they're liquid. And that means that after a while, ironically, in a down market, you end up with your worst rather than your best positions. And
That's right.
I'm terrified thinking about what might happen in the ETFs where that's automated. And then they'll go no bid. What do you see? And I realize it could be a long litany, but what do you see on the horizon in terms of one black swan and then one white swan? What do you see out there that is unexpected by most people that you think could have a bad outcome, and another one that you think might have a good outcome?
Well, to touch on some of what we were talking about before on the black swan, I think we are, and this could seem obvious, but we are over in debt in terms of a country, in terms of a global economy, and as a result, and because we're starting to see this debt come to having problems in the banking community, we could start to see some real problems, particularly in emerging market corporates, where there's an over leverage to U.S. banks, there's an over leverage to the dollar, and there's an over leverage to debt in general that's not able to keep up with their economy. So I think a next black swan could come in corporate bond markets for dollar-denominated securities in emerging market countries. The most obvious one that just happened, but is something like a Sri Lanka. I mean, if you're invested in anything there, you've got political risk, you've got credit risk, you've got transportation risk, you've got the fact that their energy markets don't work. A host of things that then impact in general what happens in the area, because they're trading with countries in the area. So if you look at Thailand, if you look at other countries in that space, you could see not necessarily the same type of political fallout, but a credit fallout. And I think that in general, the world is in danger of that. Now, on the positive side, I really see, and one of the things that just happened was the Senate passed the Inflation Reduction Act. The act does not reduce inflation. It just says that because it was politically expedient, or if it does, it's just tangential and it's just coincidental. But what it does do is that it would invest a combination of $369 billion worth of direct investment and tax incentives to the evolving or transitioning energy space. So that includes the new battery technology, that includes in the source of materials for those new batteries, whether that's iron flow, whether that's lithium for the ones that relate to EVs, in that entire space. That's on top of the bipartisan Infrastructure Act that did pass funding for those areas as well. Water is a big component of that. Water is something for which, for whatever reason, and chips, the government does have some agreement on across the aisle. Now, it's not just that the government's efficient at creating anything out of this money, but what tends to happen is it has a lift-off effect from the standpoint of investors, investments, Wall Street, funds, the 9 yards into the specific companies that are literally in the point of that upward movement. And we saw that very recently, just when that act was passed by the Senate before being passed by the House. If it does get passed by the House, in certain areas where there's going to be an additional flow of funds and additional production of new energy technologies, you're just enhancing from an economic perspective old ones. And that also helps oil and gas companies that are involved in natural gas or involved in buying the technologies that can make those processes more efficient from a refining perspective. I think all of that space, from the materials to the energy to the new energy technologies, are going to be really the upside to this period. It's where the distortion between financial assets and financial markets has some comeback related to the real economy and what we're actually seeing and needing and using.
That's interesting. I would have described that as a black swan myself, meaning that I would rather have allocated my own capital rather than have Washington allocate it for me. And in all seriousness, I think one of the reasons for the proliferation of black swans has been society's willingness to delegate responsibility for their financial future, including their investment future, to the government. I understand certainly that in the near term, shareholders of companies who are involved in those industries will absolutely, positively benefit from money from heaven and from the follow-on effect. I want to go back to your black swan, though, because I really liked your answer. I like the risk posed by companies with dollar-denominated debts in countries where their revenues are in worse shape than the dollar. And what I'm curious about is if any of those companies have large enough economy, any of those countries have large enough economies internally that they could cause systemic shock. What happened in Sri Lanka was horrific for people in Sri Lanka, but most people on Wall Street can't spell Sri Lanka, never mind find it on a map. Are there any of these frontier market economies that you think have the scale that they could give us a sort of a Lehman-style experience?
Well, I think we could potentially see that in something like a Brazil, and because it is a large country, it is quite indebted throughout its corporate structure. It is undergoing potentially a political switch when it has elections in October, and it does have a lot of dollar-denominated debt. It's also very exposed to China and the U.S. So if there's any economic slowdown from that basis with respect to the Chinese economy, that can have a negative impact on its dollar-denominated debt because it just doesn't have enough income coming into its country in order to be able to accommodate that, and it is very large. So that's a situation where there were, sort of a situation like the Petrobras situation, which happened a number of years ago, and it was a couple of elections ago in Brazil. But it did have a knock-on effect, not necessarily bringing down the world economy, but certainly in creating a lot of strain for the balance sheets of Brazil, for political fallout, and how specific banks that were exposed to that industry and to that company and to surrounding companies that were involved in a sort of a big scandal. It was called whitewash or car wash, but it was a Brazilian term, that did have an impact on bank balance sheets. And then that has an impact on how banks are lending and how they sort of allocate reserves and sort of other kinds of fallout relative to their other debts. So that's a potential where, some companies specifically can do fine, but you can have an overall credit situation. And we've seen that in Brazil. We've seen that in South America, where there could be knock-on problems. And then you have your ongoing messes like Argentina, that have had just a regular sort of back and forth in terms of restructuring debt, not being able to pay debt, taking on more dollar-denominated debt, pushing forward the idea of paying back their debt, and doing all of it with U.S. and other international banks that work with U.S. banks. This stuff continues to happen. And it sort of accelerated again because we had this other period of cheaper money, or 0% money, not too long ago in the wake of the pandemic, and we're still sort of floating on this idea. So that's a situation where I would be concerned if something like that were to happen in that country or in the vicinity. To get specific,
Okay. Afraid we have to spoil the party here and leave it on that note and move on to the next one. But Nomi, thanks for taking time to join us, impromptu here. We really appreciate it. And it was just fabulous seeing you in Florida. The panel that we did was wonderful, and your talk was excellent. So I encourage everyone to watch that talk and then also look for your new book.
Thank you so much, Rick and Albert.
Thank you.
All right. Thank you, Nomi. That was great. She knows so much. Yeah. I was if we had more time, we have this ongoing joke, Nomi and I, that the first time she came to our conference, I think it was in 2018 or maybe 2017, she did a great speech, talked about her experience on Wall Street, and that, she'd worked at Goldman,
right,
Lehman, Bear Stearns, and, two of them are gone. The other one needed to become a bank holding company,
right,
bailout. So she says, don't ever invest in a bank that I've worked at. And I interviewed her, I think, a year later, and I said, well, that was a great story, but, there aren't any other services you use or any other places, because she was talking about American Airlines at the time. I'm like, maybe we shouldn't invest in those either. So that's an ongoing joke. Darwin Green is next, and I hear that he is ready to approach the stage. So, Rick, why don't you get started? Darwin Green, tell us about him and his company.
Well, certainly Darwin is a veteran explorationist who I've known both personally and by reputation for a very long time. He's been part of several teams that have enjoyed success. Importantly now, and I'm going to let Darwin tell a story, he's involved in a high grade, hence the name of the company, high gold discovery in Alaska, and also involved in exploration activities in the Abitibi Gold Belt in Ontario, which is one of the single great gold belts in the world. Darwin, welcome. How are you?
Yeah, I'm well, thanks, Rick. Thanks for having me back. And I'm talking to you from Oslo, Norway today, from a hotel room. I'm hoping the internet's going to cooperate, but we'll see.
So far, so good. I guess we start by telling the attendees that this discussion is not a substitute for your general session presentations. Your fine general session presentation, the interview that you and I did, and of course your workshops. this discussion is meant to be had in conjunction with those. So I would encourage all of the attendees not to rely solely on this discussion, but rather to pay attention to everything else. Let's start with the most recent news from Highgold up in Alaska, the significance of these drill holes, what they've told you about the main deposit, and what they've told you about the potential to expand the deposit. I found the releases to be very cheering.
Yeah. So, just to, I guess, to frame it for the viewers here, we launched a drill program in late June, early July. We've got 2 rigs turning, and the focus this summer is dual purpose. It's both to grow the main deposit further. We came out with a great updated resource about a month or so ago, crested over that 1 million ounce gold equivalent. And but one of the things we've always liked about the project area, the property in particular, is the opportunity to find additional discoveries. When there's one deposit and the type of deposit we have, there's a chance for more. And last year we ended on a very high note in that we drilled a very spectacularly high section at a separate prospect. It was about 4 kilometers or 3 miles away from our main deposit. Unfortunately, we didn't get those assays back till the end of the year, so we weren't able to follow up on them. So this most recent news release was really just kind of giving the market an update on where we were at. And we put both rigs on that new prospect right off the hop on a fairly tight grid pattern to start with. And, just to put it into context, we drilled 6.4 meters of 580 grams per ton gold with about 2,000 grams per ton. Some pretty juicy stuff. Really wanted to understand it better and see where it goes, understand the geometry, the geology, the grade distribution. And we've the last release just updated, said we got 15 holes completed. We like what we see. Unfortunately, assays, you can't snap your finger and get assay immediate turnaround, but it's looking good, and we're anxiously waiting for the assays from that initial round of drilling.
Darwin, in my life, the part of the exploration cycle that has really made me money is when the explorationists have enough data that the drilling begins to become predictive, so that they begin to understand the sort of genesis and the lie of the deposit. How far away do you think you are from understanding the deposit and what might become a camp?
Well, that's a really good question, Rick. And we're certainly a lot further down the road than we were 2.5 years ago when we started on the project. We knew we had a deposit. We thought there was it's an unusual beast, this particular deposit. It's sort of part VMS and part epithermal. Those are deposit classes or categories. But when you know what class it is, there's certain, I guess, characteristics to those types of deposits that you can use to help guide your exploration. Because this is a bit unique, we're kind of taking conventional models and then applying what we've learned specific to this deposit and applying that exploration. And what's really cool is there's very distinct alteration and sort of that we see at the main deposit. And this new zone, which we call DC, has very similar attributes. So it's behaving exactly as one might expect, in that in these environments you get clustering of these types of deposits. And now we're seeing something that looks walks and talks an awful lot like our main deposit. We're not seeing quite yet the 70 to 100 plus widths of mineralization, but we are seeing stuff that's with decent widths and really distinct characteristics that give us some confidence that we're going to have a bunch more success as we keep working at it.
Let's back up to the main zone then. In terms of economic geology, the joke has always been that tons cost and grade pays. And so I want you to talk to that. But I also want you to talk about the importance of width, because what has impressed both myself and Neil Adshed, who introduced me to your company, has been the fact that you've had decent grades, but more importantly, you've had them over easily mineable widths. Could we talk a bit about that?
Yeah, absolutely. Grade is fantastic. You really, really want grade, but there's the mining cost that comes into it. So if all your grade is over 3 inches, it's your costs are going to be high for those 3 inches of high grade, and those can work. But if you get that of widths that are normally associated with large, low-grade, bulk tonnage type deposits where you get the economy of scale with mining. Couple that you normally associate with deposits that are maybe 3 to 5 meters wide. That's a win-win combination, and you know, it goes further than that. So we have, I would say, you know, in terms of undeveloped gold deposits in North America, probably we're very much high grade deposit over 5 grams, you know, and by a wide margin. We're kind of 10x the typical width in terms of the core of our deposit. But added to that, it's actually subvertically dipping. So you, and we see this very much as an underground mining scenario where you can access it laterally from the side and then work your way up. So you've got this beautiful combination of grade, width, steep aspect, which is again more attractive from a mine engineer standpoint. And you can access it with fairly low cost lateral development. You don't have to sink a costly shaft down to get it, and then gravity actually works as your friend as you mine it. You know, as you mine your way up, you drop it down and pull it out at the bottom rather than having to drive your way up and drive your way down.
No, rock is certainly cheaper to drop than to raise. What I'm interested now, following on to the sort of increasingly predictive nature of the drilling, is I've asked the attendees to view exploration as answering a series of unanswered questions, increasing the value of the deposit as you increase the certainty around the deposit. So if you could talk me through what you're trying to accomplish with this year's drilling season and next year's drilling season in terms of what the important unanswered questions are, and when we might expect results, and if you're willing to go out on a limb, what the probabilities of success around having the drilling become predictive are.
Yeah. Well, it's, I mean, it is about being predictive. We're not out there doing this blind. Every drill hole you put down it's a feedback loop, right, of new information that comes back and enhances your odds theoretically. I think for us, one of the big unanswered questions, one of the questions we had when we came into the project is we felt, and some of our key investors that include, you know, senior gold producers have sort of bet on the same concept, is the probability of the JT deposit itself and being an, you know, there is pretty probably it, you know, not being able to grow further. We think we can actually grow that deposit significantly, but probably equally or almost more, are you in a potential district where you can find more of these, because of the nature of the deposit, you would expect it to not be a one-off. Fundamentally for us now, last year we proved that we've got, you know, exceptional tenor mineralization elsewhere on the property. So whatever present at the time, the main deposit now got proof positive that elsewhere, which is a real win. The question is at the scale to become another sizable deposit, and then, you know, how many more of these can we find? And so we think we're off on the right track. So my goal here in the next year or two is to not just have a resource in one deposit, but to have a resource on 2+ deposits, or certainly on a second one, building that pipeline to see that there's quite clearly more to be found. Ore deposits are not easy things to find, and they take time and effort. But when you have a system like this, where you drill 100 meters of 7% zinc and, you know, 1.5% copper, those are pretty special systems. There's generally very significant driver to those kind of systems in terms of mineralization that you're going to find. So yeah, I mean, we place a high probability on us being able to achieve our goal on this project, and hopefully sooner than later.
That sort of suite of metals at that grade suggests the VMS part of the thesis. On the main deposit, what do you think the implications are with regards to extensions, either along strike or at depth? Does the main deposit get bigger, or is what you're trying to do there drill it off to get more certainty in terms of what exists?
Well, our focus right now really is, I mean, it started a bit more dual focus, because we're really trying to establish to the market that what we have has real value already. Your investment today is backstop the ounces. There's a you know, there's a real range of quality of the actual deposits and the probability that they ultimately come. We like to think that we have very high quality due to the thickness, the geometry, and this potential to grow. So our focus still very much expansion. That said, a high percentage of what we have already, we've got 85, 90% into the indicated category. So we have, not only do we have high quality resource, we have high confidence in the resource that we have. We are chasing it deeper. It's getting, the holes are getting longer and more expensive and more challenging to the deeper you go. Right. Still going to continue drilling it. We haven't been seeing the monster widths yet as we've gone way deep on it. They're kind of isolated to the upper 300 meters of the deposit thus far, but all the elements are there to see it grow, potentially flare, and or see other parallel zones within it. And it's got these attributes of a VMS, but it also has, it's not a true massive sulfide, even with those high zinc and copper. Much more like thermal in terms of how it looks. So we're kind of applying the blend of two models in one as we drill this off. And our best comparable out there is something like Hod Maden in Turkey. It was a very exciting discovery. It was actually one that Neil had said was a big fan of. It had a combination with base metals, really attractive on a lot of fronts.
It certainly rewarded me. Let's move on now to the new discovery. What would you suggest that the near-term unanswered questions are, and when might we expect some news that will cause us to be either elated or dejected around it?
Yeah. I mean, so one of the things we did this year, it took 3 or 4 months to get assays back. So you weren't getting the feedback you normally need to plan your follow-up drill holes and really follow up on new discoveries like we made. One prospect, we had no idea that it had that kind of tenor until we drilled that last year. This year, we've actually built our own prep facility. So we're doing the crushing and pulverizing on site. And that's the real bottleneck within the labs. All of this is a long-winded answer to your question, to say we've done this with the sole objective of getting much quicker turnaround. And we hope to be some assays from those first drill holes towards the end of this month. It'll probably take us a little bit of time to review them and QC and get them to the market, but we should be seeing them before. And we're quite keen on that, both for ourselves and to provide the market with some news. And we can drill here deep into October. So we got a lot of, a runway in front of us to follow up on the success if we have the success that we hope to have.
So what we're trying to accomplish there with this drill program is determine the genesis of the deposit, or is it to generate tons and grade? What are we trying? What's the unanswered
that
question
part of your
around
question,
this deposit?
Sure. So what we're trying to do there is it a one-off drill hole, or is it a deposit? Do we have the makings of an actual deposit here that has the opportunity to grow with scale? That really is the question we're trying to answer this year. Because it is a new area, geological information to give us more intel on the controls of exactly how that one formed in terms of where we best you want to kind of, and that's the program to start with. Let's do it in detail because they're so shallow and it's right at surface basically. So we're drilling 50 to 100 meter long holes that give us the kind of resolution you really want to have to then, when you're making larger step outs, you're making much more educated step outs on how you're following it out. And we're pretty keen on it. It's been very productive so far. And for us, as I say, perfect world, we're in a position to frame a resource on it the end of this year. It may take 2 years to get there, but I want to be in a place that we know we're onto a second deposit. Second goal is to see how Milkbone ties into it. It's another prospect that's a kilometer away, comes out the other side of the mountain, and it looks very much like it's part of the same system. And sort of see, is that one continuous zone? Is there a series of zones? We don't know yet, but that's what we're working on as well.
And then finally, I guess, along this line of thinking, are you doing regional work? Are you doing generative work away from these sort of 2.5 deposits?
Yeah, we are actually. I mean, it's about a 10-kilometer long trend that we're exploring along there. Some of those we hope to drill this year. We may not, but we are drilling at least a couple others. And beyond that, we're actually reaching doing very grassroots native corp owned lands that our core properties on, and that would be a full another 15-minute presentation to give you the background on the whole native corp side of things. But it's a really attractive aspect to the property and something you can feel good about.
Well, at some point in time, we'll do a subsequent interview in depth that will give you the opportunity to do that. I promise. Albert is hovering around me nervously, which means it's time to move on. But thank you for your support of the conference, and thank you for this great discussion today.
It's great to have the opportunity to talk a little more in depth about the targets. A great question. So, and great conference. We like it very much.
Thank you.
Darwin, thanks very much. We're going to go to break now so we can network again. Hopefully, you'll be able to stick around and answer some questions from attendees, Darwin, and maybe answer some questions in the Q&A chat. But with that, let's go back to networking. I hear